Hello and welcome. You're watching Money, Money, Money. I'm Sumera Abdi. When we talk about investing, really all you're actually wanting to hear is about returns. But be careful, returns are actually a factor of risk. There are many kinds of risks. For example, there are systemic risks, which mean the risks inherent to a market or markets, and these are the really big ones, which could lead actually to the collapse of the entire financial system. On the other hand, there could be systematic risks. There are also unsystematic risks, which actually mean the risks associated with any one company or say, the judgment of a court in a particular case, which could actually impact any one asset class. As we speak, in fact, there could be several global and local events transpiring, which are actually altering the returns that you can expect from the tiniest of your investment choices. So what is risk really, and what does it mean to your portfolio? Well, joining in today, we have Gaurav Mashruwala, who's going to answer all of these questions. And also with us today, we have Nidhi Saxena and Akshay Gokal Gandhi. Thanks so much to all of you guys for coming to our studio today. Gaurav, are you going to be bursting a lot of bubbles today? Instead of talking about returns, you want to talk about risk?
Yeah, because that's one thing which people miss out, and more so when things are good, the only thing that looks is return, and we forget risk, and then someday, boom, it hits her, and it's like, I never thought about it.
But Gaurav, the last time we spoke to you, and in fact, a lot of the financial planners we speak to always advise retail investors to look for professional help. So shouldn't my advisor be managing my risk? I mean, for a retail investor like me and for these guys, what is risk? Is it just that I forgot to account for inflation, or is it that I wanted to make, a lump sum investment? What would risk be?
So I tell you typically what happens. You're absolutely right that your advisor should be looking at the risk aspect or the aspects which will affect your investments. But unless you're not clear on your financial goals, unless you're not clear on your income, expense, assets and liabilities, the data which you give, he will not be able to do a justice. Because what happens is, end of the day, risk to a retail investor, and I'll talk more of a simple example, is that the amount of money required to achieve a particular goal at that point of time. So if I want, say, X amount of money after 2 years, and I've been making investment, is that X amount of money available, number one, X, and is that available at the end of 2 years? Now, if that money is not available, less money is available, that's a risk. Or if it's not available at the end of 2 years because you probably bought something which was not maturing, these both are risks. So if you have gone wrong in articulating for what you need money and when you need money, then the advisor himself will also struggle to some extent.
But, Gaurav, for example, now in this latest budget, we saw the taxation changes for non-equity funds. That's a risk for my portfolio as well. So how does a retail investor actually, prepare for something like that?
You can't. So legislative risk is something which you can't prepare for at all. You have to live with it. But that's where the issue comes in. That were you making investment keeping in mind only the tax benefit, or were you making investment keeping in mind your financial goals? Because in all probability, if you had kept, so we are looking at this particular aspect, and if you had kept in mind your financial goals and saying that I will need money after a year, but there is an added tax advantage, I'm using it, but my aim is to get after a year, and if you get money after a year, you're fine. But what was happening in this particular case is people are looking more from tax perspective and goal, and that's where they've gone wrong.
So, no, usually what happens is when we see, because when being individuals who've not invested for a long period of time, we are looking forward to, somewhere where we optimize an investment in a way where it is not a very long-term investment or not a very short-term investment, because that is somewhere where our goals lie. They are somewhere in the next 10-year line or a 5-year line. And the risk involved in that is the most, because you see some changes happening somewhere else and what we had planned for goes wrong. So how do we account for it, or how do we...
So there is no way you can eliminate risk.
Right.
It's just not possible. There are some risks that exist in system and which you can't eliminate. You have to live with it. I mean, the fact that you have parted your money is itself a risk, because you may not just ever get it back. So you have to factor in that. There are some which are not in the system. They are specific to one particular class of investment. Those are unsystematic. Now you'll have to look at both. Unsystematic risk to some extent can be tackled with the help of. So, living and accepting the fact that there are risks and taking some conscious calls and reviewing it regularly, because that's a third thing. So what you mentioned was itself a risk, that for a long time you didn't do anything, and suddenly one fine day you got up and said, I want to do that. Don't do that. Even if you don't have surplus money to invest, keep looking at, reviewing it regularly, your goals, your investments, and hence you'll be able to deal more effectively with risk.
So Gaurav, I have a question. My own personal profile is that of an entrepreneur, which is in itself a very risky profession, as I would put it. So is there something like risk profiling in individual? That's the first question. What are the factors or parameters you consider? The second part of the question is that how do you plan for an emergency situation? Let's say you lose a job, you have an accident, you can't work for 3-4 months, or your company goes bust. Is there any specific advice or rules that you follow?
So I come to the first part, which you're talking about risk profiling. Now, to say that can I do my risk profiling and just be fully sure that I'm fine, no, that's not, but you may want to use that. When it comes to your second part, that should I keep aside some amount of money for contingencies, in which you should. Now here you are not looking at return. Contingency itself is a risk, an unknown risk, and hence to tackle that you need to have certain amount of money where you're not looking at return. So you want to keep a small sum of money, say a week or 15 days provision in form of cash at home. So even if there is downpour, or if there is some kind of tsunami, even if ATM machines are not functioning, you have money to buy next day's milk and vegetable. And some more money which is linked to fixed deposit, savings bank linked to fixed deposit, so that at night if you want to admit somebody in hospital and you need deposit, you can just go and swipe your debit card.
So Gaurav, you mentioned earlier that basically a person needs to keep their goals in mind and invest accordingly. But despite that, what if I have chosen a wrong product? That in itself could be a risk to my portfolio.
So yes, it could be, because then there is a mismatch risk is what can happen. So there are instances where people would have gone aggressively investing in real estate. Now, real estate, if somebody was to say, is it a good class to invest? Definitely it is. Will it generate returns? Yes, it will. But there are instances. So I had this typical case where a family had about 4.5 crores worth of real estates and about 25 amount in shares, mutual funds, etc. And they wanted to send their son for higher education, medical education. They needed about 45-50 lakhs. They had two options. Either take a loan or liquidate a real estate worth 1 crore, a mismatch, because you had a goal. Instead of keeping that in mind and creating liquid portfolio, go into it. We have people who say that I have to make down payment for house in a year's time, but I've invested in a 3-year equity linked savings scheme. So these are the kind of things that happens where there is a mismatch between your goals and your investments, and then you are in trouble.
All right, so we've talked about a lot of risks, and if you thought we were done, we are not. We're going to take a very quick break. We'll come back in just a bit. On the other side, we'll tell you what other risks could be affecting your portfolio. Stay with us. Back in a bit.